Crazy markets. That's what we've had the last few days. So how did you handle it? Were you looking for a bug out bag, or were you realizing, hey, maybe this is an opportunity? Tune in today and we're going to help you navigate those crazy financial storms.
It's Brian Preston, the Money Guy.
So, fun exercise.
Okay. I like exercise. This sounds like it's right up my alley.
All you have to do, I could have done this with Google, probably YouTube, but I did it on Amazon. I just went on Amazon, typed in bug out bag. Do you even know what a bug out bag is?
You know, I hear you say that term a lot, and I think based on context clues I can get there, but I'm not familiar with it.
I don't know if it's because my wife likes like secret agents, like we always go to those movies or whatever, but it's for, all guys who are like special ops or spies or whatever. They got bug out bags so that, when they get the call,
they can be gone.
Because they need to either go underground or they just need to leave town. They got a bag. I guess it's not, you just had a baby, so it's not too different from you and your wife putting together a bug out maternity bag.
Yeah, like when it's go time, it's time to go.
You're ready to roll. So if you go on Amazon and type in bug out bag, it's crazy that immediately at the very top, Amazon will have a whole section saying, are you prepared for emergencies? And you can literally get a premium family emergency survival bag for 72 hours of disaster preparedness for $269. $199 if you don't want the premium one.
Okay.
I mean, I guess that means that your rations.
Right.
You don't get peanut
butter. You don't need a life of luxury.
You get ramen noodles.
Right, okay.
I don't know what the difference is between these, but it brings a great point. We had a market that got spooked. Mm-hmm. It got scared. Friday, Saturday everybody was freaking out, but Monday and Tuesday were interesting days because Friday and Monday were horrible, and then Tuesday, all of a sudden, happy days are here again. Yeah. And you're like, what in the world was going on? And my biggest thing is, I don't panic for myself. I don't even panic for our clients, but I do panic for how they will react to it.
That's right.
So I get so nervous that people, when we get into crazy financial markets, that they're going to do something to their detriment, that they destroy the potential to maximize and create the best version of themselves financially. And it happens all the time. And that's what we're going to cover today, is how to prepare yourself for scary markets so you don't make these mistakes. We are your bug out bag. You don't have to go and want to go buy this stuff where you're going to have seed banks and rations and everything else because of the financial market. You're going to know, if I get scared, hey, just go to the Money Guy Show and watch this video, listen to this show, and you're going to be okay, because we're going to prepare you. So that's what we're covering today. Go check us out, moneyguy.com. And I want to tell you another thing, a tidbit that I think a lot of you guys who are already ahead of the curve and join the Money Guy family, you knew this. If you go to our website, moneyguy.com, and just give us your email address and subscribe, there's no cost. You become a smart subscriber, and we don't charge you. You get access to all of our archives. But here's something we did that's unique, and I think that it will continue. We went ahead and sent out to everybody who's part of the Money Guy family our response to what was going on. So Friday, Monday, when that data came out and the market's going down 1,000 points, and you hear the news commentators telling you, oh my God, the world's coming to an end.
Yeah.
We sent out information to say, wait a minute, let me give you perspective. Let me tell you what historically actually happens. And then let me give you some great advice from Warren Buffett of what he thinks about these things all the way from back in 2013. And we've already received several emails back from you guys going, thank you. We really appreciate the timing of this, could not be better. And it comes to you completely free if you just give us your email address. So you are blowing it. If you don't go to moneyguy.com, give us your email address so you can get tied into the Money Guy family, and we'll keep you up to date on what's going on. Also, this is going to be out there on YouTube. And we're going to be talking about a lot of graphs, a lot of data points today. So all my nerds are like, wait a minute, I'm sitting up in my chair. Did he just say there's going to be a lot of graphs and data points? You need to go check this out on YouTube so you can make sure you get all the visual aspects of this show as well. So definitely go keep up with those aspects. But this was one that we kind of need to strap in and take off. So moneyguy.com. What other information I need to share before we just hit the ground running, Bud?
I think that's perfect. And if you're listening to this, what we're talking about is on Friday. What was the date on Friday? Was that the 2nd? Is that right? On Friday the 2nd, the market had a big drop. On Monday the 5th, there was another really big drop, and the commentators even started saying something like it's the largest drop that we've ever seen because the Dow lost like over 1,100 points, which is really just bad math, and we'll talk about why that's kind of bad math to use those numbers in a second. So one of the questions that a lot of people are probably asking is, what happened? Why did the market do this? And I think that's probably a good place for us to start talking about, okay, what caused the market to behave as frenetically as it has for the past few days?
Did you love that while we were in the midst of that? This shows, guys, and I don't want to offend anybody, but this shows the gamesmanship of how I think some of this, I take this with a grain of salt. Mm-hmm. While this was all going on Monday, do you remember what I was doing, Bo? I was yelling out, it's down 1,000, down 1,100, down 1,200, and I was driving you crazy. I think you were panicking. I was kind of making a game out of it, not because I'm not concerned about the value that's being lost, but just because I know it really does tie into what Warren Buffett was talking about. If you have a crazy neighbor yelling out crazy prices on your land or your farm, you might take advantage of the offer that he's trying to sell his property, but you're not trying to sell yours necessarily unless he's offering something crazy. Right. But it's noise in the background. Well, you're right. What actually happened? This is the most unique thing is that the market got beat up because of good news.
Well, Brian, you have to be wrong because when good news comes out, the market goes up. That's the way it's supposed to work, right?
This is because one of the transition things we're going to be talking about is what an interesting time it is to be an investor right now. And the fact that what happened is that employment numbers came back much better than anticipated. And so wage bases are starting to go up. Cost of goods are starting to go up because people have more jingle in their pocket. Right. So they're putting that money to work. And what a lot of the experts are worried about is that, oh no, this means the government is going to start raising interest rates. The Federal Reserve, the Fed, is going to start raising interest rates faster than we anticipated. So there's a little bit of pullback because we've had this thing called quantitative easing that we did a few years back where the federal government was essentially printing a ton of money into the system. And it's to some degrees, it's like a steroid that everybody's kind of gotten a little happy on the sugar high of this. So now that we know that those days are coming to a close, people are panicked about it. But I will tell you overall, I think that there's good news going on. I think it is a unique thing. We need to make sure that all of our viewers and listeners are very aware of the time. Another thing that has made this so unique is that interest rates have been artificially low for going on a decade now. That's right. And here's the thing, and I have a chart, and I know you like how I snap the pages when I bring the chart up, and I'll share this. But it's, if you look at, this is what CDs have paid historically. This goes back to the mid-80s. And you notice, when you look at this chart, you notice it's going pretty much down. I mean, there's some peaks and valleys, but it's primarily going straight down to the point that really going on a decade now, a 5-year CD is paying less than 1%. Right. I mean, and guys, it wasn't too long ago in the early 2000s, we were making 5 to 6% just on money markets. So people who are retired, who don't want much risk in their portfolio, who have historically lived off of, what the interest they've earned on CDs, savings accounts, they get nothing, right? For the last decade because of some of these things called quantitative easing and so forth.
And so what ends up happening is because they're not getting that yield, they're not getting the return on their cash or their CDs or their fixed income portion of their portfolio, they naturally are getting pushed further out on the risk spectrum. So if you need a certain rate of return to be able to create the lifestyle that you need or to have a portfolio that grows, you end up being a little more aggressive than maybe you thought. And we've seen this happen for a number of portfolios over the last decade, I would say.
Yeah, and I think that this is the problem is that we have some older people who shouldn't be taking on as much risk as they are. They're out there, they're a little ahead of their skis. They're over their skis a little bit. And it's probably a good time, and that's what we mention, and we ask this of people. When you call us and reach out and try to make a personal connection, we first want to understand your why. And I know you're going to notice a theme on most things. When we talk about vision plan, we ask you, what's your why? When we talk about what you do for a living, what's your job, your vocation, what's your why? Sure. It's the same thing with investing. Sure. I know we sound like a broken record, but there is a reason you have to know with where you're going. As you say, Bo, I love it. You talk about you've got to have a vision for the end. Yep. For where you want to be before you can get started and know the steps, the path forward.
That's exactly right.
So we want to understand the why. And here's the thing. why are you investing? I mean, really, you have to figure out what is the purpose of this. For a young person, it's because you want the army of dollar bills working for you. You want the compounding interest. For an older person who's maybe approaching retirement, the why might be, I want to have some resources growing, a portion, a much smaller portion growing so I can keep up with inflation and other things. But it's not as important. Growth becomes less important if you've done things right. So your why will be evolving and changing.
And let's be honest, all of us want the same thing. We want as much return as possible with as little risk as possible. I mean, that's really but we recognize in the world in which we live, there's a trade-off there. You don't actually get to do that. And so you have to prioritize which one of those are more valuable. And while the last few days have been painful and uncomfortable, and we've had some clients contact us saying, what's going on and what should I do? It's been incredibly educational, because it's really hard to measure what your risk tolerance is when the markets are going up and when things are great. It becomes much easier to measure when things are kind of scary.
It really does put into check that whole fear and greed thing. So I want to finish up these reasons of why, to kind of prime the pump when you're talking about this with your significant other, or talking to family members on trying to figure out what your why is that you do need to figure out first and foremost, is your primary objective growth, or is it the preservation of capital? And that's really going to be determined by your age and where you are already financially. And then we see this sometimes, and I will tell you, this is why I hope you start as young as possible. I hope a lot of the Money Guy family or young people watching this is because there is a whole group of people who are way behind. Yeah. So maybe you have to be more aggressive because you need the assets to help you grow to catch up to where you are. And that's a really dangerous area to be, but at least if you know where you are, you can take the correct measures. And then here's one we talk to people all the time. They are in growth portfolios, but they really don't have a reason to be in a growth. They've already won the game, and they're taking on probably more risks than they need to. So
when you say won the game, what does that mean?
That means that if you mathematically and financially figure out, okay, here's my level of assets, look at how much I plan on needing in retirement, funding all my financial goals, it looks like I'm there. Sure. If you're there, why take on, sure, you want to grow the assets still, but let's pull some of that money off the table, because realize, guys, we've done whole shows on you have your risk tolerance, and a lot of very successful people can tolerate a ton of risk. Mm-hmm. I mean, you guys are business owners and other things, so there's no doubt you can handle risk. But there's another component of risk called risk capacity, is that as you get to be, 50s, late 50s, 60s, even 70s, you don't have the 3 years, the 5 years, 6 years to let your money recover. So you have to take into account the timeline of what risk capacity means. Right. So if that's the case, let's make sure we pull it down to where it reflects where you are with your goals. So now that we understand the why, let's talk about some basics.
This is where the charts are coming, isn't it? This is where they're coming.
Well, because you can see on the show notes look like basically a Google search with a bunch of web links. So I'm going to try to be good with this, Bo, and you'll keep me on track with it. Is that I think that there is a huge disconnect. We all know that we want to be investors, and I commend everybody who wants to come and invest and get that army of dollar bills working. But a lot of us invest without really understanding what's reasonable?
Right.
Why do I even we had a year, we just came through a year where the S&P 500 made over 20%. And a lot of people, in the previous year it was over 10%. Mm-hmm. And a lot of people start going, it reminds me of the 90s, they start going, well, this is just the way it rolls.
Right.
But there's a reason you can make 10%, 20% is because there's risk. Mm-hmm. There's no guarantee that you're getting money, you're making money. Now, historically, over the long term, you do pretty good. But there are patches where things can get pretty rough. So when you see volatility like this, you're getting a very strong wake-up call is that, investing is not a free ride. There will be up and down times.
And so last year, the market, like you said, the S&P 500 made over 20%. But that's actually not the most unique thing about what happened last year. What I would say is probably the most unique thing that happened last year is that there wasn't a ton of volatility. I mean, we looked at the numbers, Brian. I think there wasn't a single period in 2017 where the market had a greater than 3% pullback.
Yeah, because that's what keeps people honest. Mm-hmm. Let's face it, volatility is what's going to keep you honest. Otherwise, if there was no ups and downs, every 85-year-old in the world ought to just be in the S&P 500, get that great performance. But we know that's not the case. That volatility has a part to play in giving you the rate of return. And what historically, Bo, what you're alluding to, and we have a chart that we've shared. If you were part of the Money Guy family and gave us your email address, we shared this chart with you. The average year typically has a 13.8, let's just call it 14% swing if you're talking about the S&P 500, where at some point during the year there's going to be a huge fluctuation where from day one, January 1st, to the end of it, somewhere, to the low point of the year, there was a 13.8% downturn. Doesn't mean the year is going to end up down. There's all kind of examples where actually the market had great years. You think about 2016. 2016 turned out to be a double-digit year, but the first quarter of 2016, people were talking, we're in a new paradigm. Do you remember? I mean, it always cracks me up when people talk about new paradigms, but the year ended up being good. It's just there was a lot of growth pains there in the first part of the year, and that's pretty normal. Last year, shockingly boring in the fact that we didn't have any volatility. So it gets to be that smoothness creates complacency because we start thinking, well, this is normal. We're just not supposed to go up and down. We're just supposed to expect 20% rates of return.
And the news media would have you believe, or the popular headline channels would have you believe that what happened over this last week is out of the ordinary, is not normal. But the truth is that's actually more normal based on statistics, based on the numbers, than what we saw for the entire year of 2017. So you kind of have to reorient yourself to recognize what is normal and what's out of normal, what's unusual.
So I had another chart, and this one, I mean, several of these trusts, I want to give a compliment out there because we'll make sure that we show these charts the way they are. First Trust, which is an investment house.
You think Brian listens to our show?
I'm not sure, but he said somehow we're on their mailing list, and they emailed over some great educational pieces. And by the way, I'm giving them credit because they said that this was, I made sure I read the fine print, that this was public, which was important, as well as client worthy. It has all the disclosures and everything on it. But I really liked what they did with some of these educational slides at First Trust that they put together. The first one that I wanted to share with you guys from them showed, before I even get to the point, I thought this was interesting because you and I have, this is a sidebar, I didn't talk about this in show prep. You love these. We do illustrations. I talk about it, the economics teacher who told me I could be a millionaire, and we're always trying to figure out, by the way, I just cut off a story. I got into doing this because my junior economics teacher, while I was working in fast food, said, you guys, if you could save $100 a month, you could be a millionaire. And a light bulb went off. And that's what I want to create for you guys. I sure hope that I can create the same type of excitement. But we have a lot of dialogue when we do 401k presentations. Bo likes to put rates of returns at like 6%. I like to put rates of returns on these educational, motivational type things of 10%.
Right.
You're very good and conservative.
I like to, under promise, over perform.
But I think when you're trying to motivate, it's good to show what growth can do, what that army of dollar bills can do. Well, I liked on First Trust illustration here is that it has the average annual total return since 1926.
So we're almost got 100 years of data in this thing.
It's 10.16.
It's unbelievable. Like when you think about that, on average since 1926, before the Great Depression, before the Great Recession, 10.16% average annual rate of return.
Now you're going to notice on the visual, there's some down years. Don't get me wrong, but fortunately the majority of the time there are up years. But I'm going to club you over the head on this in the future. But here's what this illustration actually shows. If we took from 1926 all the way through the end of 2017, we have two illustrations. The first is a 3-year rolling average. So we look at it, and remember, this is good. I like that we're doing 3 years. I like 10 years even better because we tell you you're a long-term investor if you can keep the money invested for at least 5 to 7 years.
Yep.
If you need the money within 3 years, it needs to be in a money market, a CD, something that's very liquid, because you're not really an investor if you need the money within 3 years. You're a person that's speculating to some degree because you're taking some chances.
Sure.
But what this shows is, and I'm just going, because you're going to see the data, it says in the 93-year periods from 1926 to 2017, just 15 of those 3-year periods had a negative rate of return. So if you think about it, out of 90 possible 3-year periods, 15 of them were negative, 75% were positive. You're doing the math. You don't have to, Bo. I think about these things. So that means there's only a 16.7% chance that it's negative historically.
Right,
Doesn't mean it's guaranteed in the future. It's not indicative necessarily of the future. But 83.3% of the time, it's positive. If you look at this on a rolling 3-year period. If you go to 10 years.
Okay.
Look what it does to the numbers. Same thing in the 83 10-year periods from 1926 to 2017. Just 4 periods had a negative rate of return.
Hold on, I'm sorry. Say that again. So, 83 chunks of time from 1926 until 2017. 83 10-year periods in there. How many of those 10-year periods had negative rates of return?
4. Or 4.8% of the time. The other 95.2% of the time on a 10-year rolling period, positive results occurred.
So what I'm hearing, Brian, what you're saying is the deck as an investor is naturally stacked in our favor, right? I mean, if the market is going to make money, whether it's a 3-year period, it's 1 out of every 5 years, or whether it's 95% of the time, on a 10-year period, the market's stacked in our favor. So why does Dalbar come out with this study every year that shows that the average investor is doing horrible? Where's the disconnect?
Because there's a lot of emotional investors, a lot of people that aren't using analytics, that aren't doing financial planning, aren't doing investment planning. They're just kind of floating out there in the wind and letting the groupthink of the time and the financial media as well as the news media and others that are trying to keep your eyeballs on the screen and on their papers more so than ensuring you're protected financially. Those things are creating noise and distractions for you. So that's why, like I said, this is your bug out bag. This is what's going to help you. So let's put some more perspective that First Trust put together another slide on the history of U.S. bears and bulls. Remember, a bear market is when the market loses 20%.
Okay.
And a bear market is just a continuation of a good performance over an extended period of time. And what I thought was interesting is this once again goes all the way to 1926 to the end of 2017. And listen to these stats. And by the way, if you look at the visual on this, you're going to notice there's a lot of blue. It happens because we tell people all the time, anecdotally, it's about every 2 out of every 10 years, you're having downturns. And you'll look at this data and kind of see the same thing.
I'm going to stop you right there. If you're someone who's listening to this and you're on the treadmill or you're on the lawnmower, while you're cutting your grass this time of year, I don't understand. But if you're doing something and you're not looking at this,
live in Florida.
Stop right now. Look on your iPod or your phone or whatever you're listening to. Make a timestamp. Go out to YouTube and look at this chart because I think of all the charts we have, this to me was the one that was the most amazing.
Is the one that grabbed you. Oh, man, you didn't tell me that.
It was eye-opening. It is eye-opening when you look at the bulls versus the bears, the frequency, the consistency, and then the girth, if I can use that word, of these bull markets is unbelievable. So if you're someone listening, go look at this chart because it really is that powerful. Okay, carry on with your thought now.
I got thrown off by the girth, but it's let's just keep reading here. The average bull market period lasted 9 years with an average cumulative total return of 480%. The average bear market period lasted 1.4 years with an average cumulative loss of 41%.
Unbelievable. And again, visually, if you just look at these things stacked up against each other, it is ice cubes versus icebergs.
And so, and this isn't on the show notes, but it's one of those things where I hear these numbers and I'm such an analytical person. I'm like, well, how could anybody get away from this? I mean, how do we fail at this? How do we not all become Warren Buffett's where we buy low and then just let the money ride? What happens? We are miserable, emotional creatures. I mean, and I think what happens is we look at this data and it empowers us. We're like, sure. But then when you're in the moment of a 2008 or a moment of 2015 where international stuff's going on, you start thinking, and I've already kind of alluded to it earlier in today's show, it's a new paradigm.
That's right.
You're like, oh, well, maybe I know we have 100 years of history, but this might be different.
The internet wasn't around 100 years ago.
Everybody always does that. And we have discussions. We have a lot. The cool thing about working here at Abound, Bo, and you know it, is that we have a lot of discussions.
That's right.
They're not debates, but we definitely are bouncing ideas. And I will have associates from time to time and say, you sure this isn't a brand new paradigm? And I just become a cynical old guy as I've heard paradigms thrown out so many times that I kind of chuckle.
Yeah.
I mean, because I just don't. I know that we're in a new world and there can be more efficiencies, there can do things, but it is amazing how markets, And I think it all goes back to Adam Smith's Invisible Hand
Right.
when you talk about Wealth of Nations, written back in the 1770s.
Yeah.
I mean, there really is an amazing thing about business, market cycles, emotions, and how they all interact with each other. So, definitely pay attention to your emotional side. And we've done complete shows talking about that, but this bull versus bear is some pretty powerful stuff.
Absolutely.
So I love that more people going out to YouTube is a good thing. So definitely take Bo up on that. So, we talked about the historical rate of return for the financial markets is, right around 10% on the S&P. Now, but here's the thing, and I don't want to lead people astray. You're not going to be a 75-year-old that has 100% of your assets in the S&P. Yes, you might make a great rate of return in certain markets, but remember, there are periods where it could go horribly wrong and you might take years to recover and you don't have those years. So you need to understand there is some benefit to having diversification, to having asset allocation work for you. And that stuff is important. And you hopefully will still get a good portion of the upside, but protect yourself from the downside substantially. Because here's what I want to talk about is what actually drives the stock market. Okay. What is going to help you? Because an understanding of what drives the stock market will help you know that there's a lot more going on than this is a casino. Because this is not a casino. I get so annoyed. And I think that is a common misconception about investing is people think, well, it's no different than I go put black or red on the roulette wheel. No.
That's not the way it works.
If it's anything, and I don't even like making this analogy because it gives credence to the whole casino, is that you are the house when you're an investor.
That's right.
But it is so much better than just betting. Because it's not betting. You're investing. You're actually putting your resources to work in companies that are growing, innovating, and doing things. So what actually is going on in the market is realize the market, just like its name implies, is supply and demand. That every time you sell a stock or you buy a stock, there's somebody on the other side of the transaction.
That's right.
So you're like, well, that sounds okay. That means if I'm making money, somebody must be losing or something like that. But here's how you protect yourself from that. And Warren Buffett talks about this all the time. You have to understand when you invest that there is an intrinsic value that, when you buy an asset, you're buying on the fact that this is a company. For instance, if you're buying something like Apple, Tesla, Google, Amazon, I guess Alphabet instead of Google. I always go back to Google instead of calling it Alphabet. But you have to look at them and go, okay, well, how much revenue do they have come in? What's their earnings, after they pay all their expenses? How does that compare to what the stock is trading at so I can come up with a price to earnings ratio? I'm nerdy enough as an accountant that I always like talking about it's a multiple of EBITDA, which is earnings before interest, taxes, depreciation, amortization. If you ever hear somebody say EBITDA, now you'll know what it means. But there's all these things that go into so you can take essentially a measurement of how much you're paying. Is it good? Is it bad? Am I getting in at a bad time?
So, but you're talking about stocks now, Brian. Now, we've talked all the time about, when we talk about how to think about looking at a portfolio and what you should invest in. We like using mutual funds or ETFs, and that's something. So you're talking about understanding the intrinsic value of a company or intrinsic value of a stock. Is there something we can use in the mutual fund world? Is there something we can look at? And are there examples in history maybe it wasn't a good time to buy because of a specific metric, and maybe other times where it was a good time to buy?
Right. Well, I think that's a loaded question because I will tell you, a person who's many years from retirement, it's always a good time to be buying because things are going up. But I think equities, but bowling it down because people want analytics. So you can't just say it's always, because it isn't always a good time to buy. But I mean, I understand in the short term, there could be fluctuations that play havoc on your emotions. So I always remind people that, like, when you're talking about stock investing, the price earnings, even with mutual funds, you can look up what the price earnings ratios of the underlying holdings are through Morningstar and other things. But then also you can get into other things, which we've done complete podcasts and money, and YouTube shows on, is index versus, is it an efficient marketplace? Is it an inefficient marketplace? So there's all kind of tools, and I don't want to get too sidebarred, but I will tell you that there are ways to figure out intrinsic value. It's not for stocks. It might be on priced earnings, but you can definitely look at the rate of return or the bond payment that you're getting bonds, premium, the discounts. There's all kind of cool things that go into, but I think the macro things that impact is what's the temperature of what's going on in the economy? When we talk about innovation, I mean, is there a new thing that is, when you talk about new paradigms, I told you I chuckle at them, but I don't chuckle about disruptors.
Right.
I mean, there's no different in the fact that I did a whole Bitcoin discussion, and we've talked about blockchain. Mm-hmm. We've talked about how the internet changed everything starting around 1993, 94 in there. I talked about when the iPod came out, when I got my first iPod in 2005.
It changed this business.
Yeah. I mean, so I am all about innovation, disruptors, and things like that. And you do need to be aware of what's going on with that stuff. And then pay attention to, taxes, regulation, that stuff. Most companies all your companies in the S&P 500 went from a 35% tax rate down to a 21% tax rate. That is going to have a substantial impact on their annual earnings.
That's right.
And that will probably impact what's going on in the financial markets. So understand how those things all are interconnected. And that leads to the next thing I want to talk about, which is the cycle of the market. You have to know where you are. And I think that's probably, I'm horrible at reading clues, just like I am with playing poker, and the fact that you have to know where you are in this market cycle. Yep. And I like, you're sitting here looking because I have it sitting right before me. I think, as I've told you about how emotionally and miserable the average human creature is, especially during down times. There is scientifically proven we remember bad stuff much more than we remember our wins.
Right.
It's just something, I think it's a holdover from survival skills, when maybe it wasn't so easy to have shelter and other things. So, I love when we talk to prospects, we talk about this cycle of market emotions. And if you Google that, you'll see there's a gazillion of these charts out there. The one we use, what I like about it is because they all use the same language. They talk about, and I'm just going to go through the traditional market, and I'll try to put the right inflection point so you get the feel for what's going on. So when you start investing, if the market's on the upside of things, you have this sense of optimism.
Right.
You start making a little money, you get excited about it, so there's excitement.
Awesome. Yeah.
And then you get to the moment where the next stage is as it continues to go, you get a little thrill from it. You're like, woo, how am I so smart? You start getting this feeling that you're doing this thing right. And then that leads to the endorphins, and you're talking at the cocktail parties at Christmas where you're thinking euphoria. Man, this is the greatest thing ever. And that's what I want to tell you. When you get to that point of euphoria, that really is the maximum point of financial risk, because things are high.
That's right.
But you are excited, and like I said, you're telling everybody that will listen to you how much money you made on this investment. Well, then things start hiccuping a little bit. You start having a little bit of downturn. You're like, okay, I got a little anxiety, but it's okay. And then you're like, next thing is it continues to go down. You go, wait a minute. It's all right. I'm a long-term investor. I can handle this. It's a temporary setback. You go through a little bit of denial with yourself, and then it keeps going down. You're like, wait a minute. No. Fear sets in. And then desperations as it continues. This thing doesn't listen to you. It's not reasonable. It keeps going down, and you start hitting panic. And then you get to that point, capitulation. You look at yourself in the mirror and go, how in the world could I have been so wrong and so dumb to even get in on this thing? How did I do this? And then you're just so upset. Guess what? This is the maximum point of financial opportunity. When everybody in the world, you're practically only whispering to your significant other that you're thinking about investing at this point, because nobody in their right mind would go and get in this crazy thing of investing. Even though it's up 8 out of 10 years, the 2 years it is down, everybody hates talking about the stock market. And there are people in 2018 that is still not investing because of something that happened in 2008.
That's right.
I mean, fact. Tell me that's I'm wrong.
100% true.
But so we go from this capitulation to the maximum point of financial opportunity. So it starts improving, but still people, even though it's improving, are in depression mode. And then things start turning. They get a little hope. Then we get relief. And then we hit optimism.
And
we start it's wash and repeat. It's like shampoo.
Yep.
You wash, rinse, repeat as much as necessary.
And so I love this market cycle of emotion. It's something we use all the time. But what I have found, Brian, and I think you'll agree with this, is that sometimes it creates the wrong impression that we are in more control than we are. So a lot of people have been saying, hey, markets are at all-time highs. I keep hearing that on the news. It keeps going up. That must be my point of maximum financial risk. I should probably sell. I should probably go to cash. I should probably pull some money out. I should probably dial it back.
And I'm glad you brought that up, because that is a point that when I do that market of that cycle of market emotion, that's more of a short-term type understanding. A typical cycle might be that 5 to 7, 8 year period, but you're going to do many of these things. And I give this analogy all the time, is that here's a basic understanding of investing that you can visualize in your head, is that when you're an investor, you really are, think about a person on a journey, a hike up a mountain. So what happens when you go on a hike with a mountain, to go up a mountain? You're going higher and higher the further into the journey you go. But the thing is you have a yo-yo. You're the type of hiker that can chew gum and walk at the same time. So you say, you know what I'm going to do? I'm going to have a yo-yo. So that yo-yo is going up and down throughout the process. And that's what's going on with these market cycles, is that yo-yo in the short term will have some ups and downs. But when you look back on the journey, and it's so interesting when we look at clients' quarterly reports, and we have a nice chart that shows their principal investment, and then it shows what the value is over time. It really looks like a mountain. I mean, it is so interesting to look at the separation from the principal investment to the growth, but you see all these little, peaks and valleys that are slowly in there, but in the long term, it looks like a mountain on the paper. It's an amazing thing.
And so I think what's beautiful is on that market cycle of emotions, it's supposed to allow you to understand your feelings and what you're going through. It's not prescriptive of behavior. If you're someone where an 80-20 portfolio makes sense for you, that doesn't mean that when you think things are good, you want to be 80-20, and when you think things are overvalued, you go to 20-80.
Yeah.
It's not prescriptive on how your behavior should be. You need to have a portfolio that you can handle, that you can sit well with, that you can rest well with, whether you're at the top or whether you're at the bottom. Because we saw this in 2013. After the market made greater than 30%, a lot of people said, man, we are due for the correction. We are due for this thing to pull out. If you're someone who made a big portfolio investment decision based on the fact that we were due for it, you are still waiting right now from 2013. There are a lot of people in 2008, at the beginning of 2008, we saw a little bit of a downturn. We saw it come down like, oh, this is the opportunity. I'm ready to go all in and throw it all out there. That's not the right, because even though you're kind of close to being in the right mindset, you're still not making the right decision. You need a portfolio that fits you, whether we're at the top or whether we're at the bottom, and then you tweak around the edges. I just think we always need to talk about behavior when we talk about emotions, because the emotional part is not prescriptive of how you should behave from an investment standpoint.
But there is a power to understanding what your weakness is in emotion.
Absolutely.
And you know me, I want to get as many charts and other things in here. I'm a hoarder. If you want to know the truth, I'm a hoarder of data.
I haven't seen this thing in almost.
It's because this thing is 10 years old practically. I mean, this is something that Fidelity Investments, they're probably, somebody from Fidelity is going to watch this on YouTube and be like, when did we do
updated that 14 times.
When did we do that? But this is a chart they did. They came out with this, I think this is what's interesting to me. This came out, it looks like in June of 2008. Mm-hmm. We didn't even hit it. I mean, 2008 is when it got ugly.
Yeah,
I mean, so this really this encompasses the .com bursting. Right. So I would love to see this chart go out even further because it would, I think, show the illustration even more. And maybe somebody at Fidelity can send that to me. But this shows the .com bubble. And what I like is it has up top the S&P 500 and what's going on with it. And then it has cash levels, the average level of cash that the investors are keeping at the time. And you'll see, guys, the average investor, when the S&P 500 was at an all-time high back in 2000, cash levels were low. Yeah. I mean, really low. But then, and this ties into the market cycle analogy that I was showing. You can see that when we were at the peak of the .com bursting, the bubble bursting in 2002, October of 2002, cash was at an all-time high. I mean, it was
just completely inverse of where they should be.
They look exact opposite of each other. And you're like, and that's why I tell you that maximum financial opportunity happens at the bad stuff. And then the same thing happens. The S&P 500 takes off. And once it gets to the top, right before, because realize that's what I love about this chart. We know we're headed for a downturn right after this in 2008. You see cash is super low again. So it's really a scary thing. And it shows exactly, it illustrates what you were talking about. Another chart that I pulled from First Trust. It talks about it was the 15th largest one-day losses in the S&P 500, and then it got in the DeLorean and said, well, let's fast forward and look at it. What did the markets do 1 year later? What did they do 5 years later? And what did they do 10 years later? And here's what the data shows is that if you average up the 15 biggest losses of the S&P 500, historically, you would see an average of a loss of 8.16%. Okay. Neither one of Friday or Monday matched 8.16%, but it's still, let's go worst case situation, that you can see 1 year later, the average, if you average up these 15 worst days, was 21.43%. So, and I talk about the pluck effect. When we talk about downturns, when you think about a musical instrument, like a guitar or something, and you pull the string down, the further you pull that string down, the faster, or a rubber band, you could use whatever analogy you want. It does recover faster because the down is fast, but the recovery can be fast too. And it's that pluck effect. But think about, so 1 year was 21.43 on average. 5 years, it was 10.92. You see what it's doing. It's reversion back to what they had average at 10.16 because 10 years later, it was 10.43. Historically, in the long term, it's trying to get back to what its average rate of return is.
And considering how quickly the markets move, how naive must we be if we think that we can time it just right? Because even if we miss a big chunk of the loss, and even if we, quote unquote, sell or go to cash or squeeze the or whatever and we miss it, are we really getting back in at the maximum point of financial opportunity?
Got to get it right twice.
You got to get it right twice, and that just is very hard to do consistently over an entire career cycle, over an entire life cycle.
So let's talk about a plan moving forward, because we've hopefully educated you. We've converted you to thinking, I'm an emotional creature. Let's put some analytical steps forward so I don't make these mistakes myself and I'm on the right path. So here's the things you've got to be thinking about as an investor. Do you have a plan? Do you have an investment plan? Do you have a financial plan? That would be step one, is making sure you're actually doing a plan.
That's right.
You don't have a map to get you to a destination.
Can't get there.
You're just not going to get there. You're a rudderless ship. So make sure you have a financial plan that works for you. Do you have a plan that secures retirement? Now your plan is going to be multiple facets. We all have goals. We want the kids educated. We want the house paid for, but we also want to have a good retirement. So you got multiple things working. You want to make sure they're working together, that those arrows aren't going all over the place. Do you know where you'll get cash if things get bad? We get this question from even very successful people, where they've built up a lot of assets, but they're like, okay, I'm thinking about transitioning. I am transitioning because I'm hitting retirement, where I've been a saver my whole life, but now I'm going to be a consumer or a spender of my resources. How do I do it? What's the plan for, where do I get these assets, and where do you get them? Man, if things are really bad, where do I get the assets? Have a plan for that. Know where you'll get the money. And how should you diversify?
That's right.
You need to know yourself. You need to know what your age is, your risk profile, what your goals are. They all need to be working to create some type of risk plan so you know what you're doing and what type of diversification you should have that reflects that. And as Bo has already told you on the show earlier today, the diversification is what's going to help you out during those dark days, because you're diversified, you'll have some conservative assets to make it through that cold winter or make it through that long journey on the ship of financial peril, which the oceans can get pretty choppy in that. You like all these visuals I'm throwing out there?
All over the place.
So, and then here's another thing. I just give you anecdotal information, is that if you're losing sleep, something's probably wrong.
I'm going to say that even a little bit differently, because it's so fresh in my mind, and because we fielded so many phone calls on this and so many listener emails. If you hear that the market lost 1,100 points and it has you questioning your investment strategy in your portfolio, the risk inherent in your portfolio might not be just right for you.
Yep.
Or maybe you don't understand what the risk inherent in your portfolio is. You need to reconcile those two things, for sure.
So I wanted to I showed that whole illustration how the average investor is horrible with their timing of the market and usually hoard cash at the wrong time. Market starts getting beat up. They're like, oh my goodness, let's get out. So they build up as much cash as possible. So if you're one of these people that's thinking about going to cash, you had a little bit of, ups and downs on Friday and Monday, and you're like, just get me the heck away from this thing. Let me give you some coping tools to know, to figure out what your path forward is. The first thing is have an honest assessment of what you'll need, and when you'll need the money. If you're 15 years from retirement, guys, hit the snooze button. I mean, seriously, if you are freaking out and you're 15 years from retirement, you do not understand how investing works, and you probably need to go follow up with some more Money Guy resources to make sure you're not
go
one of
look
those people.
At all the charts we just shared, for sure.
reevaluate the asset allocation. As we talk about, if you're losing sleep, if you're freaking out about this, you really should take this as an opportunity to reevaluate the asset allocation, especially since we've had a slight recovery since those 2 choppy days.
Right.
Perfect time for you to kind of look at that. We do this. I hate seeing people just tell me it's an all or nothing. It's not a binary decision where I'm either going to be invested or I'm going to cash.
That's right.
I think that for a person that's panicking, freaking out, and you really are at the cusp of just going straight to cash, how about coming up with a coping situation where maybe you go to cash with a portion, but then you start dollar cost averaging over a short period of time, or a year, 6 months,
That's
12
right.
months, 18 months. I can't tell you because it's more of a personalized decision, but those are things that let you take advantage of the volatility, but also get you some sleeping money. I only want you doing this if you're one of those really special people that's thinking, I'm getting out of everything. I mean, because there are a certain portion of people that scares me to death, because that just means you're leaving everything to where now you have to get it right that second decision.
And let's face it, going to cash is an emotional decision, but sometimes it's just necessary for people to be able to deal with that. What you're going to find, and we see this all the time for folks who come to us that maybe previously they had gone to cash, you will enter into this area of analysis paralysis,
Yep.
where once you have that cash, what do I do now? So if you are someone who's going to make that decision, which we would encourage you not to, think about a system you can put in place that day to go ahead and start getting that money back to work, so you remove the decision-making process from yourself.
And Bo, I'm shocked you didn't put this, because you're so much better at this than me. I think that this is also where a professional can
sure.
come into play. We talk about it, and you can go to our websites and you'll see it. We talk about who are the type of people we work with. There are very successful, very smart people who've done a great job on the do-it-yourself. It ties into our whole abundance cycle. If you go learn, grow, implement, use as much of the free stuff we're sharing with you, but you will get to a level of success that you're going to go, man, I'll tell you what, this thing is so big.
Sure.
I'm scared when it has these things, not because I'm not questioning how good I am with it, but it's just that this is an enterprise that's now 7 figures.
That's right.
Headed towards 8 figures. I need some help making sure that nothing's getting off track, because there is a calming nature when you know someone has your back, that someone's looking over your shoulder, there's some consensus, collaboration that's going on. So if you are freaking out and you have a decent level, maybe you do need to have a professional in your corner to help you out. So I want to kind of close things out and talk about, because we talked about all the negatives.
Right.
Is there a silver lining to volatility? Mm-hmm. I think this is an important question.
Sure.
And I love this because this all came about probably 4 years ago. I had my first podcast listener who wrote me, and he coined the term that I'm a financial mutant when these things happen. And I started thinking about it, because I'm the same way. I can have this big portfolio, but on days my 401k contributions are going in, or my retirement plan contribution, this is going to sound sick. I kind of hope for a little bit of a down day on those days that it purchases it. So it turns you into a financial mutant, that you're actually rooting for volatility on the days you buy, because you know that when you have a strategy where you're buying on a monthly basis, just no matter what's going on, you're buying. Those bad days, that volatility actually creates buying opportunities for you to take advantage of. So if you're a young person, try to become a financial mutant where you celebrate these downturns, because they create opportunity for you going forward. I think in the long term, this volatility and these downturns also, it's the analogy of your grass in your yard. Every spring, you're supposed to dethatch your yard. You probably don't, but if you want a really green yard and a really good looking yard, you have to, there's things you're supposed to do besides just fertilize, Bo. You don't just cut the grass and fertilize it. You have to dethatch it. You also have to aerate it. There's things you do. So I look at this as a dethatching process. I can tell you're shocked.
I've never even heard the term dethatch before.
They do it. Think about, okay, let's use another analogy, because guys, I'm over his head on the grass cutting. If you own a timber farm, every so often they'll come in and they clean out the rows. That's another way you can think about it, as a dethatching. They clean it out so you make room for the roots to grow and everything, to the nutrients aren't being crowded out. It's the same thing with the financial markets. If you, like I said, if the S&P 500 never had volatility, you would have 85-year-olds all hanging out in there too, because why wouldn't you? If we could all get guaranteed 10% rates of returns, this is what we all should do. Right. But that's just not the way it works. So think about it as a cleansing, a dethatching process to make sure that we get the people out who aren't supposed to be in the financial markets. And then short-term volatility, I think of, especially when you have this wake-up call where you have 2 days where you get cold water thrown on you, and then you get a, whoo, okay, wow, that wasn't as bad. It's okay. You get a kind of a do-over.
Yeah.
Use this short-term volatility to look at your personal situation and go, maybe I am outside of my skis. Maybe I am who Brian is talking about. I'm that 62-year-old that has way too much S&P 500 in my portfolio. This is the time I think short-term volatility can be that wake-up call.
Absolutely.
That you need to be doing something a little different. And I want to, by the way, we've thrown a ton of information at you guys. So if you want to take the relationship to the next level, because that is the final part of the abundance cycle, is after you come, learn, implement, and grow your assets, and you get to that point where you need somebody over your shoulder to help you out as your collaborator and team member, look at Abound Wealth. Look at the Money Guy Show. Go to our contact page. It's moneyguy.com. It's aboundwealth.com. Yep. Love to work with people. We work with clients all over the country. But I could not help it, Bo, if I didn't close out the show with just reading the quote from the greatest investor of our time, which is Warren Buffett.
I feel like right now you are buttoning up your sweater, you're taking your shoes off, you're sitting by the fire.
They are making I don't know if it's a documentary, I don't know if it's a spoof, but they're doing something on Mr. Rogers. And I grew up with Mr. Rogers, and that's probably why I feel so comfortable in sweaters and sweater vests and everything else. But I do feel like I'm getting ready to share some wisdom to close this out. So, this was in our, what we sent out to all of the Money Guy family as well as our clients. And we titled it Good Advice is Timeless. And this is from Warren Buffett's 2013 Berkshire Hathaway letter to shareholders. Before I start reading this, one of the things I thought was interesting because I'm guilty just like everybody else. I feel like I have to because you guys count on us to know what's going on in the markets. I turn on CNBC and all the other stuff like everybody else does. And immediately they start talking about the machines. This is a flash crash caused by all the automated trades and everything else. This is from 2013. Here we are in 2018. This is in here discussed too. So this shows you how timeless good advice is. So I'm just going to read this. This is from Warren Buffett, 2013 Berkshire letter to shareholders. It should be an enormous advantage for investors in stocks to have these wildly fluctuating valuations placed on their holdings. And for some investors, it is. After all, if a moody fellow with a farm bordering my property yelled out a price every day to me, at which he would either buy my farm or sell me his, and those prices varied wildly over short periods of time depending upon his mental state, how in the world could I be other than benefited by his erratic behavior? If his daily shout-out was ridiculously low and I had some spare cash, I'd buy his farm. If the number he yelled out was absurdly high, I could either sell to him or just go on farming. Owners of stocks, however, too often let the capricious and irrational behavior of their fellow owners cause them to behave irrationally as well. Because there is so much chatter about markets, the economy, interest rates, price behavior of stocks, etc., some investors believe it is important to listen to pundits, and worse yet, important to consider acting upon their comments. Those people who can't sit quietly for decades when their own farm or apartment house too often becomes frantic when they are exposed to a stream of stock quotations and accompanying commentators delivering an implied message of, they'll just sit there, do something. For these investors, liquidity is transformed from the unqualified benefit it should be to a curse. Mm-hmm. A flash crash or some other extreme market fluctuation can't hurt an investor any more than an erratic and mouthy neighbor can hurt my farm investment. Indeed, tumbling markets can be helpful to the true investor if he has cash available when prices get far out of line with values. A climate of fear is your friend when investing. A euphoric world is your enemy. During the extraordinary financial panic that occurred late in 2008, I never gave a thought to selling my farm or New York real estate, even though a severe recession was clearly brewing. And if I owned 100% of a solid business with good long-term prospects, it would have been foolish for me to even consider dumping it. So why would I have sold my stocks that were small participants in wonderful businesses? True. Any one of them might eventually disappoint, but as a group, they were certain to do well. Could anyone really believe the earth was going to swallow up the incredibly productive assets and unlimited human ingenuity existing in America?
So good.
I mean, it's
so
2013.
good.
I mean, he had no idea that on February of 2018, CNBC was going to be talking about a flash crash.
That's right. Yeah.
So, good advice is timeless. We hope you find the Money Guy Show timeless. This is going to reside out there on YouTube World, out there in iTunes, Stitcher, however you like to consume your dose of the Money Guy Show. Just connect with us. We believe in this abundance cycle. If you'll come, learn, implement, and grow your assets, we know down the road we'll get our dividends because you're going to want to become part of the family. And we're just so blessed to have you. Go to moneyguy.com, go to aboundwealth.com. We'll talk to you soon.